Hey everyone, and welcome. Today, we're going to break down a trading strategy that gets a lot of praise for being both simple and surprisingly accurate, which, makes it pretty much perfect for beginners. We're talking about the MACD crossover strategy. In fact, the source material for this explainer calls it one of the simplest and most accurate trading strategies out there. Our goal here is to give you a really clear rules-based method that helps you sidestep all those common mistakes and false signals that can be so frustrating when you're starting out. So first things first, before we can use this strategy, we've got to understand the tool itself. So let's decode the MACD. What exactly are we looking at when this indicator pops up on our chart? Now I know, moving average convergence divergence, it sounds like a real mouthful, right? But don't worry. All it really is a tool that simply tracks the relationship between two moving averages of a stock's price. That's it. And really, the whole thing just boils down to these three key parts. You've got the MACD line, the signal line, and the histogram. These three components are all we need to keep our eyes on. So, what's the big deal with these three things? Well, think of them as a window into the market psychology. They help us gauge the momentum, the strength of a trend, and maybe most importantly, they can signal when a trend might be about to turn around. All right, basics are covered. Now for the fun part, the blueprint for buying. This is the actionable, step-by-step process for identifying a potential uptrend you can trade. And look, these aren't just suggestions, they are strict rules. First, you need a bullish crossover. That's when the MACD line physically crosses above the signal line. Second, the histogram has to confirm this, but flipping to positive, forming above the zero line. And third, this is your safety check, the price has to be trading above the 200 exponential moving average, which tells us the bigger trend is on our side. All three have to match up, no exceptions. Getting into a trade is only half the battle, right? You absolutely need a clear exit plan. For a buy trade, your main target is usually the most recent peak or swing high. Your stop loss gets placed just below the recent valley or swing low. And for those of you doing shorter-term intraday trades, you can use these percentage-based targets and stops here. Okay, we've covered buying. Now let's flip it around and look at the blueprint for selling. And the great thing is, it's pretty much a perfect mirror image of the buying rules, which makes it really easy to remember. So just like we said, it's the exact opposite. For a sell, we're looking for a bearish crossover, where the MACD line dips below the signal line. Then, the histogram confirms it by moving below that zero line into negative territory. And finally, our trend confirmation. The price has to be trading below the 200 EMA. Again, all three conditions must be aligned. And the exit plan? Yep, that's inverted too. The target for a sell trade becomes the previous swing low, and you'll place your stop loss just above the previous swing high to protect your position. It's all very systematic. This all sounds great when the market is clearly moving up or down. But what happens when it's just flat, chopping sideways with no real direction? This is the MACD's primary weakness. It's kryptonite, and it's absolutely crucial to understand this part. So, how do we avoid those frustrating false signals? Well, our source gives us three fantastic pro tips to help filter out the bad trades and seriously improve our accuracy. Okay, first, the trend is king. That 200 EMA is your best friend. Don't trade against it. Second, just try to avoid choppy, sideways markets or stocks with really low volume. The signals there are just unreliable. And third, and this is a big one, always zoom out. Before you take a signal on a 5-minute chart, for example, click over to a higher time frame like the 15-minute or 1 hour to make sure the larger trend actually agrees with your trade. Listen, if you take only one thing away from this whole explainer, let it be this. The real power of this strategy is that it combines a momentum signal with a confirmed trend. It's not just about the crossover. It's about the context that the crossover happens in. That is the crucial point. So what we have is a clear, rule-based framework for trading that brings together both momentum and trend. So the final question is, with a system that defines your entry, your exit, and your risk so clearly, what could that unlock for your own approach to the markets?